Good morning or afternoon, everyone, and welcome to the Audit Implications and Testing Lessons Learned from Early Adopters webinar presented by Hein & Associates. We are pleased to offer complimentary webinars each month that cover a wide range of finance and accounting topics. I'm Shannon Reddy, your moderator and webinar organizer today. You should have received an email from ReadyTalk with information for the webinar that included a PDF attachment with materials that will be helpful to understand the subject matter discussed today. Please check your inbox of the email address you registered with to locate these materials if you have not already downloaded them. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A, but please ask questions throughout the presentation. The webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE for this session, you will need to be connected for a minimum of 75 minutes. You must answer 75% of the polling questions included throughout the presentation. Immediately following the webinar, you will be directed to an online evaluation form that must be submitted in order to receive your CPE certificate for the course. Please check your inbox later today for a follow-up email that will include a link to the evaluation as well. Our presenters today are Gregg Saul, Michelle Carr, and John Monahan, all partners in our Denver office. Gregg provides a wide range of audit and accounting services for both public and privately held companies. He assists clients with financial reporting and complex transactions such as initial public offerings, IPOs, private offerings, and mergers and acquisitions. And he has an extensive expertise in debt and equity finances, share-based compensation, income tax accounting, purchase price accounting, and SEC reporting. His focus is in the alternative energy, technology, and manufacturing and distribution industries. Michelle began her career in public accounting with Hein & Associates in 1999. Since that time, she has primarily worked with technology and software firms, manufacturing distribution companies, and clients in the mining sector. Michelle serves both privately held companies and publicly traded corporations, overseeing a variety of assurance engagements and consulting projects. Her assurance work has ranged from audits for SEC and IFRS engagements to due diligence services and other agreed-upon procedures. In addition, Michelle provides technical support on complex accounting issues, advises on revenue recognition, inventory, as well as matters of impairment, goodwill, and mergers and acquisitions transactions. John joined Hein & Associates as a partner in 2016. With over 25 years of experience, he specializes in providing advice to corporate taxpayers. In particular, John advises companies on tax compliance and income tax reporting matters, which include tax filing positions, complex transactions, ASC 740 reporting requirement, and Sarbanes-Oxley 404 requirements. He has served clients in both the public and private sectors, working with firms and organizations both large and small. John has in-depth technical knowledge of ASC 740, income tax compliance, tax implications of mergers and acquisitions, and international tax matters. We thank you all for attending today, and now I would like to introduce Gregg Saul.
Okay, thank you, Shannon, and welcome everyone. Welcome back for those of you who took part in parts 1 and 2 of our webinar series. We're now moving into the third installment of the 4-part webinar series on the new revenue recognition standards. And thus far in parts 1 and 2, we've really focused heavily on what I call more of the technical components of the standards that have been issued. I think today we're going to move much more into a little bit more open discussion, observations of of what we've seen out in the marketplace, especially with early adopters, how to prepare for it, et cetera. So moving just a little bit away from more of the technical requirements. And just as a reminder, for parts 1 and 2, went through the process of the effective dates and the transition, 2 possibilities for transition methods. Most of the time really spent on the 5 steps for recognition of revenue under ASC 606, first one being identifying the contract with the customer, identifying separate performance obligation, determining the transaction price, allocating the transaction price, and finally recognizing revenue when performance obligation is satisfied. So then the next slide, I think we go to our first polling question.
Thank you. Polling question number 1. Did you attend any of the webinars in this revenue recognition series? Please make your selection from the following. I attended the first webinar, part 1 only. I attended the second webinar, part 2 only. I attended both part 1 and part 2 of the series. This is the first of the series that I have attended.
So it's good. It looks like a pretty large percentage have been in attendance for parts 1 and 2, and then some others joining us for the first time. So I think, as we talked about, this will be a nice transition that would be easy to get into if it's your first jump into the webinars, because we're kind of moving around in the approach here. And just real quickly, a few of the other topics we had talked about in our first 2 series were accounting for contract costs, which is the new codification section, in addition to the new codification section for revenue recognition, accounting for warranties, and then principal versus agent considerations. So what are we going to talk about today? The objectives for today, we're going to start out talking about some of the observations of what public companies are reporting. We are going to move into, and I hope everybody had a chance to download the separate PDF that was sent out. Within that is several sample disclosures that we've compiled and put into a PDF that just is much easier to look at in a Word or a PDF document than to try to put that onto slides, plus should hopefully be very good resource material as companies move forward into adopting the standard. We'll go through the specific disclosure requirements. Michelle's going to talk about sample implementation plan, internal control considerations, very important question of what to expect from your auditors. And then John Monahan is here to talk about some of the income tax accounting implications. So on this first slide, we're just putting out there, out of the S&P 500 companies, there's basically 7 that currently have early adopted. This is according to Audit Analytics, which is a research tool that we subscribe to, and they put some nice reports out here over the year as the standard has kept coming closer. And wanted to list here just the companies that had early adopted, and when we get into the disclosure requirements or sample disclosures, this is largely where those have been pulled from. In addition to that, about 20 Russell 3000 companies have adopted. So it's not just the S&P 500 that are early adopting, but as would be expected with a standard like this, there's not a large population of companies that are choosing to early adopt. Should just point out, and we're going to look at some disclosure from Microsoft here shortly, but Microsoft will be early adopting their June 30th fiscal year end, and so their first quarter of fiscal 2018 will be coming out in the next probably a couple weeks, and that's where we'll see their adoption for the first time. So just kind of looking at this list, what I think is interesting is looking at where the impact to the companies really is. And it also gives us a little bit of a snapshot as to, we talked about the different adoption methods, and it lets us see who's adopted through which methodology. So Alphabet Inc., if you're not familiar with, that's Google. So their impact to opening retained earnings was $15 million reduction of retained earnings, which ultimately would be indicative that that revenue will be increased in future periods as they adopt. United Health Group, really not a material impact with their adoption. First Solar Inc., always a very interesting company to look at. They're into a lot of different, even though it's a solar company, I think they cross a lot of different industries. Personally, I was a little bit surprised that their impact was just a reduction of $437,000 to beginning retained earnings. Ford Motor Company, $36 million impact. Raytheon, $91 million. And then the largest of the group here is General Dynamics Corporation with a $684 million impact. And they're basically a aerospace defense type company. I think Raytheon and General Dynamics both are aerospace defense. CBOE Holdings, again, this was, they early adopted, but the impact was not material, which may have had an influence as to why they decided to early adopt. So to look real quick at the anticipated adoption methods, really was not too surprised by this, given the level of work that would go into a full retrospective adoption and the benefits, cost benefits of doing so. What we can see here is majority of companies that have at least disclosed their method of adoption are indicating that they're going to adopt using the modified retrospective method. However, of that, there is this 230 that's still sitting out there that has not disclosed their adoption method. Just a breakdown by SIC code of where there's going to be significant impact and what exactly are those significant impacts. So what we can see here for business services, recognition of a service fee at a point in time rather than over time. Prepackaged software, the biggest impact in that arena is going to be recognition of software licenses in particular at a point in time rather than over time. Real estate investment trust, gains from sales of assets based on the transfer of control rather than continued involvement. Air transportation, and this probably would kind of carry over to general retail environment as well. Loyalty programs and the accounting for loyalty programs or breakage fees or that sort of thing is where they're anticipating seeing the significant impact. Telephone communications, capitalization of commission costs. Remember we talked about the new codification, ASC 340, that's getting much more specific on the costs that should be capitalized or deferred based on your revenue recognition. National commercial banks, this really gets into gross versus net reporting, so it would not have any impact on their net income or loss in this case. Insurance agents, brokers, and service, recognition of the brokerage revenue at a point in time rather than over time. So just a few other observations from looking at some of the disclosures out there with the public companies. With aerospace and defense, Boeing is reporting the significant impact is currently they're recognizing revenue as deliveries are made or based on the attainment of performance milestones. And the change that they will be doing with the adoption of ASC 606 will be to recognize revenue as costs are incurred. So they're basically changing from a milestone method to an input method of recognizing the revenue over time, and that will create a significant impact for them. On the other hand, on the next slide, still in the same industry of aerospace and defense, General Dynamics, what they're anticipating is recognizing the revenue in the second bullet point there at the bottom, and they actually have already early adopted, but recognizing at a single point in time when control is transferred to the customer. This is for their manufacturing of aircraft. And that's generally when the customer accepts the fully outfitted aircraft. Previously, they've been recognizing revenue at two contractual milestones: when aircraft were completed and accepted by the customer, and then when the customer accepted final delivery of the fully outfitted aircraft. So it's really going the opposite direction here, in that they're ultimately looks like deferring the revenue until final delivery and acceptance by their customer. So on the next slide, software and technology. And if you do have hopefully you do have the handouts printed out. On the first set of disclosures we provided is for Microsoft, which I mentioned just a few minutes ago, is in fact early adopting, but as a fiscal year end of June 30th, their 10Q is not out yet. So what this disclosure is the disclosure out of their 10K that was filed on June 30th of 2017. And just by way of point of clarification, I guess, is we're given a lot of examples of public companies. We're not trying to just focus on public companies. It just happens to be the best source of information, because it's very easy to go out and pull that information off of services where you can pull down their 10Ks and 10Qs. So as we expected with the standard, the public companies are who we're going to look at to implement with private companies as well, even though there's differences for public versus private. So kind of the key points in Microsoft's disclosure here, and they really did a very good job of detailing out exactly what the impact was going to be. So the primary impact, and we kind of alluded to this a moment ago, was recognition of Windows 10 license revenue at a point in time rather than over time. So in that industry, presumably they didn't have VSOE, and they were recognizing Windows 10 license over the period of the various contracts, as opposed to recognizing it up front at a point in time. Overall, what the impact is going to be, and what they've disclosed here, is that for fiscal year 2017, because they are going to do a full retrospective application, they're going to go back and restate the 3 years of income statements that they're presenting. Fiscal year 2017, they're going to increase their revenues by $6.6 billion. And then for fiscal year 2016, that's an increase in revenue of $5.8 billion. And I kind of thought with Microsoft that's worth putting in perspective, because I think we all know Microsoft is a massive, massive company. So what is their total revenue for fiscal year 2017? That was $90 billion. So this is a 7.3% increase to the revenue that was reported. So even with $90 billion in total revenue, I would say a 7.3% increase is a material impact to their operations. Some of the other elements, and just looking at the controls, and we do not intend to go through these in full detail. We're just, again, providing some examples, and I'll kind of highlight on some of the key points as we go through here. But the first highlighted paragraph in that example we sent out, what I thought was interesting is really looking at the internal controls that they've changed as a result of implementing this standard, which is something Michelle's going to get into later in our presentation, is what impact do these have on the controls. I also thought that how very specific they truly got in their, they are disclosing that revenue will in fact increase by $6.6 billion, which immediately tells me that their auditors have to be more or less fully through auditing of their implementation efforts, such that they can disclose that in a 10-K, because anything in these footnotes is subject to the audit opinion. Again, we'll get into some of those elements later on, but just something that really struck me is how specific they're getting is going to require the auditors to have to be really kind of fully signed off on their implementation as of June 30th, 17, even though they're adopting in Q1. The rest of this, it's providing a nice table. You can go through and look at exactly what the implications are. With that, we'll flip back to the slides. And so last time we had Megan McFarland, one of our partners out of Dallas, gave us a kind of high-level overview of what the impacts to the oil and gas environment were going to be. Happened to be looking at this excerpt from Exxon from their June 30th, 2017 10Q, and really what that's saying is their biggest impact is going to be the fact that the taxes collected are no longer going to be grossed up in revenue. So it's not going to have any impact on their net income. It's just going to change their top line revenue and get the taxes that were paid out of that top line number. Okay, so I was trying not to jump into the details at the start of going into the specific requirements, but we do have to kind of go through the presentation and disclosure requirements that are within the standard. So first, just start on some balance sheet considerations. And you can see the codification reference number here. So some of the elements that are potentially changing with the new standard are contract assets, contract liabilities. Accounts receivable certainly isn't a new terminology, but we are seeing much more clarification of how that is defined, which in my opinion is very, very beneficial. So maybe just to start with accounts receivable, what's been discussed there and the standard talks about is in order to recognize the accounts receivable, the company's right to consideration must be unconditional in order to recognize an accounts receivable. So in order to be unconditional, only the passage of time would be required before payment of consideration is due. So some of the factors to consider here is, does the vendor have a contractual or legal right to bill and receive payment from the customer? Will the vendor commence performance within a relatively short time frame? Is there more than a 1-year period between advance billing and performance that might be indicative that perhaps you don't have accounts receivable that should be recognized? The reason for the importance here is I think we have seen a fair amount of diversity in practice where, at least some companies, the policy would be to once they invoice the customer, they'll go ahead and recognize that as accounts receivable, and it could just result in a gross up of the balance sheet. typically would just result in the gross up of the balance sheet from the standpoint that you get accounts receivable and deferred revenue. The question is then, is that appropriate to do? So this has given us some pretty specific guidance as to when that is appropriate to recognize that accounts receivable. And again, we've got to get down to the level that it must be unconditional, that the customer is required to pay us as the seller of the product. The contract assets and contract liabilities, again, that's well, at least partially coming out of the requirements for cost deferral. The only point I have on that is, even though these are the titles that are used specifically within the standard, it does state that that it's not prohibited to use, companies are not prohibited to use other terminology for contract assets and liabilities. However, a company shall provide sufficient information for a user to distinguish between contract assets and accounts receivable. So it's really driving on this differentiation between accounts receivable, which kind of are, accounts receivable, I would say, is certain to be received with the exception of credit risk, versus certain contract assets, which would be like a cost deferral type scenario. So then to get into the disclosure requirements, and just the overall objective here is to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. And for those of you familiar with the standard who took part in parts 1 and 2, you've heard us talk about the level of judgment that is involved in this standard versus bright line rules that I think we're used to in the United States here. Again, a lot of these disclosures, as you go through them, I think it's important to refer back to this overall objective to determine, are you disclosing the appropriate level of information? So important to get that disclosure objective out there. Then in order to meet the disclosure objective, you need qualitative and quantitative information related to the contracts with customers, significant judgments, changes in judgments made in applying the guidance to those contracts, any assets recognized from the cost to obtain or fulfill a contract with the customer. And then with that, I wanted to just, before we get into a little bit more detail on the requirements, perhaps let's just look at one of the samples that we sent out. The first one after Microsoft, which starts on page 4, is First Solar. And again, this is a solar company. I could say they, somewhat construction real estate in their project development, solar project development. They also manufacture into a lot of different revenue sources. So again, this is just a sample for us to look at. We see the full gamut here. In this case, as I compile all the various revenue components into this footnote, it's probably 6 pages long as to what they're disclosing. I don't anticipate everybody's going to be at a 6-page long footnote. In fact, some of the ones we've looked at are really no more than a couple paragraphs long. So it just will depend on the complexity of what is going on in the company. They've traditionally really broken out their sources of revenue, so continue to do that, breaking it out as at a point in time versus over time. On page 5, probably the second full paragraph down, they get into a discussion of where their variable consideration comes into play. and it starts kind of striking us that variable consideration is probably much more prominent than one would think in just an initial read of the standard. Down at the bottom, they talk about their energy generation revenue, which actually is accounted for under ASC 840. There is a requirement in the standard to break out revenue streams if they're, and this is one of the perfect examples. If you have leasing revenue, it should be separated from revenue from contracts with customers. And I believe that's about all I was going to necessarily highlight into that. Well, actually, on page 9, then there is, because we're going to jump in here for one of the public company requirements, is the disaggregation requirement, which I think is one of the bigger impacts of the new disclosure rules. So on page 9, you can see how they have broken out their disaggregation of revenue. Again, I don't want to go through all the detail here. Discussion on their change in estimates on the following page. Roll forward of the contract assets, liabilities, etc. Page 11, they have backlog disclosures, which again I think is a significant audit component. That's something that traditionally has not been in footnotes that us as auditors have been necessarily required to deal with. So with that, then we'll jump back to the PowerPoint and go through a few of the specific disclosures, and really just more of the fundamentals related to the disclosure. You know, number one, these are not meant to be a checklist of minimum requirements. And also, companies are not required to include all disclosures that are not relevant or material, which, again, that's a very important point because we don't have to go through and put all of these requirements into the footnotes if they're clearly not relevant to your company. So really, in other words, you know, again, here, reflect back on the overall disclosure objective and disclose what you believe is appropriate to meet those objectives. So in the next set of slides, we really are focusing on, this is kind of a table that I really like because it breaks out the differences between public entities and non-public entities. So these first two requirements are applicable to both. As I alluded to a moment ago, you've got to break out revenue from contracts with customers, separate from other streams of revenue such as leases. Impairment losses, there is a requirement in the standard that any accounts receivable impairment, contract asset impairment, things of that nature must be presented separately or at least disclosed separately from other impairments such as you know, intangible asset impairment or something of that nature. So disaggregated revenue. Again, I see this as being one of the heavier components because it is new, it is different than segment disclosure. And there could be a lot of information to go into this disclosure, but what we see here is for public entities, it is different than non-public entities. And for non-public entities, you're able to scale that back quite a bit, but still get into the qualitative factors of different disaggregation components. So I think what's important here is to look at, you know, conceptually, the aggregation or disaggregation should occur such that useful information is not obscured by either the inclusion of a large amount of insignificant detail or the aggregation of items that have substantially different characteristics. It's kind of a long sentence, but what I just said is don't disclose too much, don't disclose too little, get it exactly right. But that's really what the FASB has said, you know, and I agree with this. I mean, sometimes we see companies that just have way too much disclosure in there, such that it gets confusing to the user of the financial statements. So you don't want to go to the extreme where you've got too much information in there, but we'll have to disclose enough information to be able to see that disaggregation at an appropriate level. I mentioned that this, you know, again, for public companies, there is a requirement to disclose segment disclosures. That's been a key area that our regulators have been very hot on, issuing comment letters, et cetera, on whether their segment disclosures are appropriate. This is not necessarily the same as segment disclosures. It's probably more than segment disclosures. However, you should reconcile back to what you're reporting in your segment footnotes. That's for, again, just for public companies here. Private companies generally would not have segment disclosures. Some of the considerations as to how to disaggregate your revenue. What are you disclosing externally? For instance, earnings releases, annual reports, investor presentations, and what information is regularly reviewed by your chief operating decision maker. That's a terminology. It's kind of separately defined in the segment disclosure requirements. So again, here we can just see this kind of continues on down the path of what potentially is required under the disaggregated revenue requirements. Look at timing of revenue, sales channels, generally any other breakdown that would be helpful for the users of the financial statements. Next slide then. I think key point here, and we've already talked about the disaggregation disclosures will need to be reconciled back to the segment disclosures. It's a requirement to disclose information about your contract balances. Ultimately, what this is going to result in is kind of a roll-forward format of your contract assets, liabilities, et cetera, as a result of implementing the standard. The next slide, again, just a continuation of what's required in that roll-forward format. You've got to separately present the revenue that was recognized in the reporting period for performance obligations that were satisfied in previous periods, i.e., you've got changes in the, you know, perhaps variable consideration or something of that nature. Information required about the timing of future revenue recognition. Again, this is where we get into what's kind of commonly called backlog. And the board observed that there's a number of entities that voluntarily disclose backlog. I will say that mostly in our practice, we generally will see that more in the MD&A for a public company or something. Not as much in the footnotes, but that backlog has never been really defined, and so this is just a very specific, it's not a specific definition of backlog, it's just a specific requirement to disclose what future revenue will be recognized based on performance obligations that have not been met as of the balance sheet date. So required disclosures around performance obligations. When you do have separate performance obligations, disclose when those are typically satisfied, i.e., upon shipment, delivery, as services are rendered, completion of services, etc. Any significant payment terms, any types of disclosure of types of warranties and related obligations there. Need to disclose significant judgments, and again, there are a lot of significant judgments involved in this new standard. So, timing of satisfaction of performance obligations, and then the transaction prices and amounts allocated to various performance obligations in the contracts. With regard to contract cost in ASC 340, so stepping outside of ASC 606, but 340 was created to deal with the deferred contract costs, contract liabilities. So disclose key judgments that were made in determining the amount of costs incurred to obtain a contract, the methods used in determining amortization, closing balances of assets recognized from the costs incurred to obtain or fulfill contract with the customer, and the amount of amortization or impairment losses recognized. Then I just wanted to put out, we didn't put this in the materials, but example 42 in the implementation guidance, and actually examples 41 through 43. If you go to the 55 section of ASC 606, which is where the implementation guidance is, pretty far down towards the end, gives some good examples of what some of these disclosures may look like. So that would be a good resource also to look at as you're first preparing your footnotes here. One quick point on SEC requirements. So it is important to note, basically, if you're a calendar year company, you'll adopt the standard. If you haven't early adopted, which most haven't, you'll adopt in Q1 of 2018. Point here is that all full disclosure under ASC 606 and 340 will be required in every quarter up until that first 10K is filed, and that's just based on the requirements of the SEC. In your first quarter, when you've got a change in accounting principle, you do have to put those full disclosures in there. So caution is just don't think that you'll only need to report quarterly information on that. The other point here, and we've kind of been talking about this for a while, is that still in quarters and 10Ks yet to be issued, the SEC really is looking for very specific disclosures related to the impact of recently issued accounting pronouncements. They did come out in the AICPA conference last year in Washington, D.C., and harped on that a bit more. This year, we've actually seen some comment letters that have been issued to companies for ultimately not disclosing enough information as to how they're going to adopt these key standards, primarily ASC 606, and then the leasing standards being the primary ones, and there's some other ones in other industries that would be important. And so again, what we did with the sample disclosures, tried to go through and copy out as much information as we thought would be beneficial for companies as you're looking at first drafting the financial statements. And so we've got a selection of companies in your handout, General Dynamics being one. Again, that's an aerospace defense type company. Alphabet, which is Google. Interestingly, they happen to be one of the shorter disclosures in there. Ford is another one you can take a look at in here. And then Raytheon, which is another aerospace and defense company. So really, rather than going through these in detail, I wanted to get you the requirements and then get you some sample disclosures so that you can, independently go through this and kind of read through here, and you can, also see the impacts of what this is doing to the companies, kind of as we showed on one of those earlier slides. So I'm not going to spend any time going through all of these handouts with you, which, probably is a relief to you, but I wanted to get the material to you so that you have it as reference material. And so with that, we're going to jump to our next polling question.
Thank you, Greg. Please make your selection after the question. Does the following company have all the required data accessible in their systems to make these disclosures? Please select from the following. We have all of these disclosures under control. We are still debating internally. We have not started to assess the impact of disclosures. Please make your selection now.
Okay, so it looks like largely we're starting debate internally. A few of you that have everything under control, about 15%. And then some of you have not started to assess the impact. Okay. And with that, we will jump over to Michelle.
Okay. Great, thank you, Greg. So this first slide talks about the implementation strategy. It's just really a proposed strategy for the company if you guys are still kind of trying to figure out where you are and how to get started, or maybe if you're in the middle of the implementation, really assessing if you've hit all the major areas. But the first phase is really the initial assessment, so really understanding the standard, and hopefully this series helps with that. Performing a high-level assessment, really identifying those gray areas that are specific to your business, which will be more subjective for you, and then really documenting at a high level the impact or summary. And then moving into the planning phase, really addressing the timeline, the resources the company has to devote to this, budget and transition approach. Moving into controls and system impacts, do we have the right tools? What kind of reporting will we need and the templates to accomplish these things? Lastly, phase 3, the implementation. So finally getting to documenting accounting processes and controls, performing contract analysis and data aggregation, and then moving into your auditor's favorite part, the technical accounting memos and financial statement disclosures. I think it's important to acknowledge that another critical process is to include the audit committee or board of directors in your implementation process. They will need to be well informed of the progress to date, significant changes, and anticipated hurdles encountered or anticipated. There was a guide that was put out by the Center of Audit Quality that was released for a tool for audit committees in helping with this new guidance. So if you guys need any help, you should be able to find that out there. But if you need any help, certainly reach out to us and we'll help you get connected with that information. And we have another polling question. Yes. After seeing the levels of implementation, what stage is your company in the process? Please make your selection from the following. Phase 1, initial assessment. Phase 2, planning. Phase 3, implementation, or our company has not started. So it's looking like the majority of you are split. Either you haven't started or you're still in that initial assessment. That's not really surprising to me, but it is important to probably move forward and really figure out what the next steps are. So let's talk about internal control considerations. I thought I would start with a quote from Ford directly out of their disclosures, which says, changes in internal control over financial reporting. Beginning January 1st, 2017, we implemented ASC 606, revenue from contracts with customers. Although the new revenue standard is expected to have an immaterial impact on our ongoing net income, we did implement changes to our processes related to revenue recognition and the control activities within them. These included the development of new policies based on the 5-step model provided in the new revenue standard, new training, ongoing contract review requirements, and gathering of information provided for disclosures. So it's important to acknowledge that, I think in the very beginning, Gregg talked about what their actual implementation adjustments really were, but they're saying on an ongoing basis it won't have a significant impact. However, there still are these controls that are impacted and the management of the changes of those controls. So I'd ask you to keep that in the forefront. So companies will ultimately need to update their risk assessment to identify controls over both the implementation process and their ongoing accounting. We will at a top level talk about the COSO framework and some suggested considerations through those as we move through these slides. But you will see there's an ongoing repetitive theme here in making sure that you're really addressing controls both at the implementation process as well as the ongoing accounting and reporting processes. So keep that in as you think through each of these areas. And then there's certainly the risk out there that if you're behind on implementation as you move forward, that there is a higher chance of getting a material weakness related to controls over both the implementation and ongoing reporting. So just one more push to kind of keep going. So as we move through the COSO framework, if we look at the control environment, management sets the tone at the top for importance of proper implementation and designating the importance so it's important to get it right from the beginning. Has the entity allocated enough resources to properly implement the standard? So that will certainly be a heavy assessment to evaluate whether your current accounting teams can handle what's coming towards them at this point. And develop a plan to train all the affected businesses. So these implications will certainly go beyond your accounting and tax departments. So some areas to consider is your legal, finance, and sales teams and how they're contracting, reviewing contracts, those sorts of things as we go through that. In terms of risk assessment, assess the financial reporting risk for the adoption and ongoing reporting. So determine the process to get complete population of contracts and contractual terms. So it's going to be important for everybody, but most certainly if you have non-standard contracts, this is going to be a significant issue in determining that you're really evaluating each contract and including all of those specific items. And by doing so, you'll be able to reduce the risk of not identifying a contractual term that may have a material accounting impact or significantly reduce the risk to an acceptable level. Consider if new opportunities or incentives exist related to fraud risk from changes resulting from the adoption. So we're really talking about, are there new opportunities and incentives which make the company vulnerable to fraud? Control activities. Assess whether the transaction level controls over accounting for revenue from contracts with customers and the costs to obtain and fulfill these contracts are designed and operate effectively to properly mitigate new risks to an appropriate level. And then of course, typically IT follows right behind that, so IT general controls over the new and revised system. Information and communication. Evaluate whether there are modifications needed to the systems for internal reports used by management reporting to external parties. So we're verifying the new standard pushes all the way through the financial statements and helps to maintain the quality and integrity of the information that you're putting out. Monitoring. As we put new controls into place, you're ultimately going to need to monitor these new controls and or modified controls to address risks of the new standard and the ongoing reporting. Documentation. From an SEC perspective, this isn't new, but just wanted to throw out the reminder that when you're making these changes to ICFR, you're going to want to make sure that you have documented the design of your new controls, the modifications of existing controls, and entity level controls. That will all have to be considered in in your documentation and likely be requested by your auditors. You'll need to include how significant adjustments and final decisions were reached. Otherwise, you're at risk for your auditor to conclude that there's a design deficiency. So it's particularly important for subjective management review controls to make sure that you're really figuring out how that will be documented and what considerations go into those final conclusions. So estimates, there's certainly more estimates than we've historically seen in legacy GAAP. And so, some of those things might be identifying contracts and performance obligations in the contracts, or if you have situations where there's variable consideration and how to apply that to the transaction price. So if you really look at new processes to address these estimates, will likely create new controls over those processes. You're looking at transaction level controls will need to be addressed or new ones created to ensure the data used is complete and accurate. And then likely management will need to identify these significant assumptions, evaluate the method and model that it uses to develop them, and evaluate both supportive and contrary evidence to indicate that those were the proper conclusions. So from a control perspective, those are just very high level, but hopefully that gives you an indication of the level of scrutiny you're going to need to add to controls. The COSO framework is primarily used at this point by public companies, but certainly many of these considerations in the documentation for public companies and what your auditors are going to be asking for is a good indication of some areas that you might want to consider. So I think we have a polling question next.
We do. Related to internal controls, which is likely to cause more trouble in your company? Please make your selection from the following: the control environment, the risk assessment, control activities, information communication, monitoring controls, not sure.
So these results are, they're kind of all over the board here, but I do think that it makes some sense that many of you are in the not sure category based on where we are in the implementation process, because as you define your process, the controls will likely follow. So thank you for your responses. So what are you going to expect from your auditors? This is all really quite new to us as well. There was the PCAOB issued a staff audit practice alert number 15 in early October, really stating what the expectations were from the auditors. It was really intended to help facilitate the interim and year-end audit surrounding the consideration of the new revenue standards. And I think it's valid they point out that revenue is one of the largest accounts for many filers, and certainly an important driver in the financial results of companies. And so they've provided some additional guidance for us to get through this. So in terms of transition disclosures, we're going to need to perform procedures to identify and assess the risk of material misstatement of financial statements, really including consideration of the risk that there's omitted, incomplete, or inaccurate disclosures. We're going to be required to do some substantive procedures to test the relevant assertions related to those financial statement disclosures. And I wanted to point out, we're still going to have to do some substantive procedures, even if the standard isn't expected to be material to your financial statements, so that we can form the same conclusion. We are going to need to evaluate whether the financial statements contain essentials for fair presentation. So again, the omitted, incomplete, or inaccurate information, and the evaluation of these items on the financials in total. And if you are part of an integrated audit, there's going to be testing and controls about whether the company's controls sufficiently address the risk of material misstatement for significant disclosures, including those transitional disclosures. we're going to need to perform procedures with respect to interim financial statements. So is likely that will include inquiry of company's implementation process and anticipated effects, and obtaining evidence about whether interim transition disclosures agree or reconcile to the supporting data. The interim procedures really are going to follow the standard objective to determine if any material modifications need to be communicated to the company in respect to complying with GAAP, and procedures are generally limited to inquiry, analytical procedures, or procedures deemed necessary. And some examples to that might just be the inquiring of the company personnel, as we've mentioned, and then ultimately, if the auditor, it's left up to judgment if they need to see additional evidence, that may as well be requested. If there's a concern regarding management's application of the new standard, there is a responsibility by the auditor to inform the audit committee. So it's going to be important to, as you're working through these processes, to make sure your auditors are on board as you make final conclusions. And so we talked about the transition disclosures, but in respect to the transition adjustments specifically, we're going to need to evaluate any changes in accounting principles. So is the new principle or methods in compliance with GAAP, and are the accounting changes disclosures adequate? Understand the transition method. Are you using full or modified retrospective transition method, and the cumulative catch-up adjustments? So was it was the standard properly applied, and if you used practical expedients, were they consistently applied? Assess the risk of material misstatement related to adjustments. So looking at the design and implementation of audit procedures that address those risks specifically. And then assessing internal control over the transition adjustments, including testing those controls. So ultimately, we're testing for reliance at that point on those controls. Obtaining company-produced information, so auditing those underlying assumptions and looking at that detail, and then testing the accuracy of the assertion that the impact is immaterial. So if you've stated that it's immaterial, we're ultimately going to have to do enough work to conclude that we're in agreement again. Evaluate if there are new or heightened fraud risks, making sure that the company hasn't improperly is properly identifying performance obligations, and being sure that the allocation of transaction prices isn't being modified to defer revenue. And lastly, addressing misstatements in proper year financial statements that are discovered in this process. So in terms of internal controls, we're going to need to perform walkthroughs of controls for new or modified processes. We're going to need to test the information system and manual controls, really understanding the IT system and related business processes, really looking at how the system was used to implement the new standard, manual and automated controls and how those were designed. And are there spreadsheets being used as part of the transition process and the controls related to those? Testing management's review of controls. How are these designed to operate to prevent or detect misstatements? So we're really looking for thresholds, other sort of factors that really go into that individual review process, and what ultimately passes the test at that point. Test reviews of interim financial information. So update auditors' understanding of the business, really looking at those controls to perform analytical procedures and other interim procedures, including inquiries of management. Identifying and assessing fraud risks. So we'll be required to presume there is a fraud risk involving improper revenue recognition and evaluate the risks associated with that presumption. So consider fraud at various levels of the company. We're going to perform inquiries. Ultimately, we will brainstorm where the risk might be greater than other places in the company, and considering incentives and pressures for management to commit fraud. Lastly, evaluating the risk of management override of controls. So as an example, with a small company, there is more involvement by senior management in determining revenue recognition, so we'll have to devise our testing to account for those situations. Auditors will be required to consider if revenue is recognized properly under GAAP. So we're going to be looking at understanding the contractual arrangements, auditing accounting estimates related to revenue, and performing substantive analytical procedures to test revenue. So historically, many of the PCAOB inspection audit deficiencies that have been reported, many of them come from revenue recognition, so there's certainly a heavy reminder from them in their alert on these particular areas. So for contractual arrangements, how performance obligations were determined, the transaction price, how it was determined, and when purchase orders are ultimately satisfied or cost to fulfill the contract as they relate to them. Looking at those estimates, really evaluating the appropriateness of the assumptions used, considering the new judgments being applied with the new standard, and including variable consideration, standalone selling prices, and then certainly the progress towards completion of satisfaction of any performance obligation. And then looking at the testing of revenue. So, if there's plausibility and predictability of relationships, really challenging those and making sure that we understand what kind of expectations there would be and refining the precision of those expectations. Auditors will be required to evaluate if all the required disclosures regarding revenue have been included. So assessing the level of disclosure around contracts, where historically there have been little information provided. So I think as Gregg went through the disclosure section, you can see that it will certainly be more voluminous, and you should be expecting where you may have had a couple of paragraphs to maybe be in the 1 to 2 page, even larger than that size for just this particular footnote. And then ultimately understanding the information system, including the period in financial reporting process. So as you really go through this, make sure that you're talking to your auditors and make sure that decisions are being made and determining when some of these procedures will happen, because as things roll out for Q1, it's going to be a pretty tight time constraint at that point to be auditing and getting comfortable with those Q1 disclosures. So hopefully you guys can come up with a timeline that makes sense to really get through those, whether that's in your year-end audit or sometime prior to that, to minimize the pressure on both the companies and your auditors as you get through that section. Shannon, do we have a polling question?
We do. So the next question is the thought of what will need to be prepared to address auditor questions concerning? Please make your selection from the following: yes, no, not sure.
So many of you are saying yes, it's concerning. Ultimately, I would say, much of that and many of the judgments will make our job harder. So certainly be documenting all of your considerations, not just your final conclusions, and that will help us to get through your thought process as well. So I'm going to turn it over to John to talk about tax implications.
Thank you, Michelle. I'd like to spend a little bit of time talking about how this new revenue recognition standard might have an effect on those companies that are tax-paying entities and have current and deferred income taxes on their financial statements. So the adoption of this new standard may actually and likely will create new temporary book tax differences or remeasure existing book tax differences. And one of the main areas that it could affect is this area of advanced payments. And a little background on that is when a company receives advance payments, of course, it not always recognizes the revenue right away. It will record deferred revenue and recognize it over a period of time. That timing of the revenue recognition can be different for book purposes and for tax purposes. So for book purposes, we expect either acceleration of revenue or a deceleration of revenue, and that can increase or decrease the deferred revenue recorded. The permissible methods for tax purposes are either to record on a cash basis, meaning all revenue recognized when the cash is received, or to be able to defer it, but only for a period of 1 year. And the thing about that is if you've picked a method and you've done it for 2 years, you are on an accounting method. And to change that, you have to do an accounting method change. And that can be automatic or non-automatic. But one of the main areas where we have some concerns are where advance payments are received and for book purposes they've accelerated revenue. That means that the deferred revenue will go down. And one of the requirements on the tax side is that we can defer revenue for a year, but cannot defer any more than when it does for book purposes. So if they've reduced that deferred revenue, tax also has to accelerate the revenue and reduce their deferral as well. So that's one of the main concerns, and we believe that that could cause a need for an accounting method change, in that you need to be aligned with that first year of revenue deferral that will be recorded for book purposes. So there's some debate whether that's going to be an automatic change or a non-automatic change. I can tell you currently it's not listed as an automatic change, but the IRS has released a proposed revenue procedure that would put that on the list, and for these kinds of changes that are occurring through this new ASC 606, it will accommodate that to make it an automatic change. It's not final yet. They've put it out as a preliminary or proposed regulation and invited comment, which they've received a lot of comment on it, so we expect it to be an automatic change. So should you have to do that, you will file a 3115. If it does end up to being a non-automatic change, you have to do it ahead of filing your tax return or ahead of the year end, and it has to be advanced. It has to get advanced consent from the IRS and pay a user fee. Hopefully we're not going to end up there. It'll be an automatic change where you attach the Form 3115 to your timely filed tax return. What likely will happen is you'll have a catch-up adjustment, basically catching up that revenue that was supposed to be recorded for tax purposes in prior periods. If it is in that situation, you'll have a 4-year proration, and so that catch-up adjustment won't be all at once, but you can take it ratably over a 4-year period. So there's also the thought about revenue recognition itself and whether tax aligns with the book revenue recognition. Now, as we've seen with the new standard, it's very contract driven instead of formerly rights and rewards driven under the old GAAP system. That old system was more aligned with how tax recognizes revenue. So there is some concern about whether this new recognition standard that is contract driven and relies a lot on control as being a major contributor or major factor in that passage of control, whether that creates a new book tax difference. And so we really need to understand that. And also there's that factor where there's this variable consideration that can be included in the contract price instead of when, for example, a contingency is out there that needs to be resolved to be considered revenue. That is the old method under GAAP. That is what tax respects. So if there's this element where there's this variable consideration included in the contract, we need to be cognizant of that and understand if that's in there and understand if we've got a difference for book and tax purposes. So for tax purposes, generally the rule is that revenue is reported in the period in which the income becomes fixed and reasonably determinable. And when we say fixed, we're talking about the earlier of when it's been due, when it's paid, or when it's earned, okay? So earlier of, and so that can be different than what's currently going to happen with this new revenue recognition standard. So for the sale of goods, income for tax purposes is usually taxable upon the shipment, delivery, acceptance, or title passage for goods. For services, it may be taxable as the service is rendered over a period of time. So getting our arms around that and whether we can be on the same method as for books, or if it's really different because of the tax requirements. And because of this change for book purposes, we're now in an impermissible method for tax purposes. If that does occur, then we're also looking at having to file an accounting method change. So if the same methods are used for financial reporting and tax purposes and you're finding that you're still under permissible method, you simply can adopt this new method and be on a permissible method as long as you're not running afoul of the deferral rules and you're still within the guidelines, the framework of what's permissible for tax purposes. So that's the current provision and what dictates kind of these book tax differences on that current provision. Now I'm going to talk a little bit about the deferred provision. So again, back to the advance payments, increased book deferred revenue will result in a larger deferred tax asset. Basically, so we decelerating revenue, we're going to have a higher deferred revenue balance. We can only defer for tax purposes, again, 1 year. If it carries out more than 1 year, we're going to have a larger deferred revenue balance, and that will create a higher deferred tax asset. So on the other side, if we're accelerating revenue and we're decreasing the deferred revenue, we're going to reduce the deferred tax asset. And this is where we have to be careful because we can't, like I said before, defer revenue more for tax purposes than for book purposes. What we should never see is a deferred tax liability position related to deferred revenue because that would indicate we are deferring more revenue for tax purposes. In that case, we've got a problem. So be very careful of that. And like I said, this is a main area for consideration on this revenue recognition standard and how it affects income tax accounting reporting. So also on the deferred tax provision, you might have a separate deferred tax item for this accounting method change should you have to do it, and that's when you set up a deferred tax liability. You are going to roll that out over the 4-year catch-up period. So that could be a separate item on your deferred tax roll-forward schedule, could be included in your deferred tax liability. So that's a consideration. One other consideration, part of this new standard is some of the costs of obtaining a contract need to be capitalized. For tax purposes, the default position is also to capitalize costs of obtaining a contract and to amortize that over the life of the contract. However, there are certain types of costs that under different provisions in the income tax code can be deducted when paid, or at least 2.5 months paid after year-end. And a prime example of that is accrued commissions. So that in itself could create a deferred tax liability. So for book purposes, we're capitalizing these types of costs, say accrued commissions, and for tax purposes, we're deducting those. So I would expect to see a deferred tax liability arise out of this situation. Okay. One thing we really need to consider as well is if we're having to maintain a tax system of revenue recognition, are we maintaining a way of gathering information that will quantify that for us for tax purposes? Most companies are going to go on a new system of recording revenue, and their processes and their IT systems will gather that information for that purpose. But if we've got a different system, a different accounting method for tax purposes, are we maintaining that old system or a system of quantifying what we're going to need to report for tax reporting purposes? So that is something we need to think about. The adoption of this may create process and system challenges if multiple accounting bases are needed to be maintained. there's a few other considerations that we need to think of aside from what I've just talked about, and one of the major ones is transfer pricing implications. And this change in revenue, how that will change certain transfer pricing methodologies, primarily that rely on revenue and profits-based methods. So a revisit to that strategy to see if that strategy is something you want to maintain, if you're in alignment with that strategy, is how that affects your transfer pricing calculation. And if that strategy, you're looking at your different foreign jurisdictions and you're looking at ways to optimize your worldwide tax efficiency, if that strategy makes sense based on rates in different jurisdictions. So that's something to consider as well. Now, Gregg and Michelle have talked about this full retrospective method and modified retrospective method. Just have to make sure that the tax considerations, any tax adjustments that roll out of this revenue recognition change, is considered, say, for example, in any cumulative transition adjustment. So that needs to be a net of tax number if there are any changes to, for example, a deferred tax asset or liability. That has to be considered. Another primary area that has to be looked at is if you maintain a controlled foreign corporation and you're not permanently reinvesting, or you haven't taken the position that you're permanently reinvesting the earnings, you will be recording a deferred tax liability. Now the question is, will that deferred tax liability change because of this revenue recognition change at the foreign entity level? And likely that it will, because it will change your book basis in that investment. And what that changes is your quantified deferred tax liability, which is the difference between your tax basis in your foreign investment and your book basis in your foreign investment. So that needs to be looked at as well as part of what is changing in your deferred tax asset liability composition. So those are the three things that we need to consider as well when we're talking about this new standard. And so that is it for the things that I wanted to talk about on the income tax accounting side and how the effects will reverberate with the tax side of it. So I will turn this now over to Shannon.
Thank you. So now we have time for a Q&A session. Please use the chat box located in the lower left-hand corner of your screen. If we don't get to your question during the webinar, our presenters will follow up with you via email. Some questions we've received during the presentation are related to the required disclosures. If our company does not have all the situations covered by the disclosure requirements, how would you propose this gets disclosed? Should we list out all of the required disclosures and say NA to those that are not applicable?
Okay, I can respond to that one. And with respect to that, again, we go back to what generally is in any of the accounting standards is to only disclose what is relevant. So there would not be a need in that case to disclose every component, but merely to disclose those components that are relevant to you. You would not need to, for instance, list it in your footnote and say it's not applicable to you.
Okay. We have another question. How much additional testing will be required in Q1, and how do you propose addressing this issue?
So we talked about this a little bit in the presentation, but I mean, ultimately, I think Q1 will be difficult with the timing of the filing of the year-end financials and then the volume of new disclosures rolling into Q1 and getting everybody comfortable with those. So my suggestion would be to work with your auditor to figure out what needs to be done and can be done prior to that time period, and to help really push some of this through as you're getting close to your year-end field work and wrapping up that audit. So that should help reduce the workload and the time constraint. If you're working with your auditors, hopefully
the first time they are seeing the documentation is not in Q1. So if there's good communication well in advance, it'll be easier for everybody.
Okay. Another question. Why would any company choose full retrospective?
So that's a very good question, and generally what I would see as the basis for that, companies that are doing a full retrospective adoption, I think the best example goes back to that Microsoft example where they're going to be increasing their 2017 revenue by, I think it was $6.6 billion, but a material amount. Theoretically, what could happen with a modified retrospective method of adoption with that is that revenue, that $6.6 billion, could get ghosted or lost. In other words, it would never show up on the revenue line item for their financial statements if they did not do a full retrospective adoption. That's kind of the biggest reason I would point to as to when you would choose that method.
Okay. Thanks, Greg. We have another question. If changes in revenue recognition cause accelerated revenue from advanced payments, will that always require a change in the tax accounting method?
Thanks. That's a very good question, and I think the IRS generally views a change in timing of revenue recognition on advanced payments as a change in accounting method, and especially where you've been on the same method for 2 years and you've adopted a method. So that will require a change. Now, again, what we're hoping for is it's an automatic change and it's going to be fairly painless to do it. Mm-hmm. So I think that the answer is yes.
Okay. We have another tax-related question. What is the IRS form required to change tax reporting method to agree with book reporting? And are several companies adopting this change?
The form that's required is a Form 3115. It's probably 6 or 7 pages long. It's pretty in-depth, but only a part of that form needs to be completed for this type of change. I haven't seen this done now, but I know companies are talking about doing it. I haven't seen it on a return yet. So.
Okay. All right. We have our final polling question now. Do you plan to attend the last session of this 4-part webinar series on November 2nd? Yes or no?
And that was overwhelmingly yes, so thank you.
Yeah. Thank you.
Incidentally, that session, November 2nd, we're really going to get into systems requirements, methods of automating, our technology management consulting group. Mike Parker in particular will be primarily leading that session, so it should be very interesting. Perhaps just a couple points to kind of close out, and I'll just reiterate, I know we're focusing heavily on public companies, but that is because of the fact that that is the information that is widely available to us. Also, as we talked about audit implications, that was a lot of that was derived from PCAOB audit risk alert that recently came out. That specifically relates to public company audits for us, but what I can tell you is that as auditors, we typically look at what the PCAOB, the SEC is putting out, and to the extent applicable, we kind of, that then becomes applicable to private companies, again, where that's relevant. So those are the types of things we will be looking at. I think with that, I would just thank everybody for attending. And Shannon, do you have some?
Yeah, thank you guys, Greg, Michelle, and John, for your participation and information you shared. For the attendees, in just a moment, after the webinar, you will be directed to an online evaluation form. Please fill out the form in order to receive your CPE certificate for the course. In order to receive a certificate for CPE, you're required to be connected to the webinar for a minimum of 75 minutes with 75% of the polling questions participated or answered as well.
Please allow up to 4 business days to receive your CPE certificate. Thank you all again for attending and have a great day.